Hello, I'm Jamie Gordon, editor at ETF Stream, and today I'm delighted to be joined at Ecosystem Unwrapped with Samarth Sanghavi, head of fixed income at VettaFi. Samarth, thanks for joining me today for a quick chat.
Pleasure to be here, Jamie. This is fantastic, by the way.
I'm glad you like it. So can you tell us a little bit about how VettaFi is getting into the fixed income space, where you think you can add some value and innovation?
Yeah, for sure. So VettaFi bought the Credit Suisse suite of bond indices last year. In a previous life, I used to work at Credit Suisse, running the suite of bond indices at Credit Suisse. So when the indices were brought here, VettaFi reached out to me and asked me to take my old job back, basically, which is pretty cool. You know, it's nice to see some of the products I built 20 years ago are still alive and kicking. So as we onboarded the suite, our first foray into fixed income already gives us a very good base of products that have extensive history, extensive live track record, and a huge amount of institutional client segment already looking at this market. So we landed up with a suite that gives us beta exposure to the entire fixed income space. That's where we get started, right? That's only our starting point at VettaFi. So as I took on the role at VettaFi, one of my goals was to reimagine how we think of fixed income products. You know, these indices, they've been live since the late 80s, early 90s, so lots of history, lots of track record, but they're also old. They're 30 years old at this point, and the world has changed. The market around us has changed quite a bit, especially with the advent of ETFs, ETF trading. The bond index world is very, very different. So one of the things we want to focus on is create a suite of products that has significantly better tradability and a reflection of the market that we are in. Today's benchmarks suffer from a core issue that they are all market cap rated. That's not a good or bad thing. That's one way to look at the world. But what that means in practice is when we allocate our portfolio, we will now allocate to the company with the most debt without necessarily looking at the quality of that debt. That's not how I want to allocate my personal money. Right? We want to rethink about diversification here. In today's benchmark index, the top 10 issuers account for 13% of the index. Is that really diversification at this point? No. Again, it's one way to look at the market. So what we're bringing to the market here is we have created a suite of fixed income indices that remove this overconcentration. And we do that by taking a set of 200 issuers and equal weighting them. So there is no bias as to which names you're holding. The names are pre-selected based on the largest available in the marketplace, and then we allow full security selection from these names. The way we think about it is, our belief is that the index should not decide what represents an issuer. That's really the portfolio manager's job. We want to give the issuer names and then provide every single security available in these names for the portfolio manager to trade. It's a long answer, but the last thing we did here is we removed a persistent turnover problem. You know, if I was reimagining fixed income from scratch today, I wouldn't design something that forces me to buy and sell securities every month. Why should I do that? It's not quite conducive to my portfolio. So we create an index that's rebalanced annually. So the set of issuers is fixed. You have full visibility into who's going to be in the index for the whole year. We do a monthly maintenance, so bonds get in and out of the index. You know, if something matures, something is downgraded, the rating of balances changes, all that maintenance will be taken care of. But the core set is constant. And that already provides an enormous edge for a portfolio manager managing a product like this.
Just pulling one of those threads that you raised there, the question around market cap weighting issuance within traditional fixed income indices. This is a calling card of active managers within the fixed income space, especially here in Europe, where 80% of UCITS AUM in fixed income is actively managed.
Right.
One of the other calling cards, of course, is active managers say, well, we can take advantage of risk premia, which you might not be comfortable doing within passive strategies. Are there reliable risk premia that can be replicated and captured in a rules-based approach?
That's a really good question, Jamie. Look, I think about this on two dimensions. Risk premia that could be wrapped up in an index format needs to have consistency and harvestability, right? Because it's a rules-based product. So if something is idiosyncratic, that's challenging for an index. When we look at credit risk today, that's how I view credit risk, especially in the IG space. It is persistent and it's harvestable. a statistic here might be helpful is since 2006 in the US IG market, there has been one quarter where triple B spreads have been lower than A spreads, right? Which makes sense. I mean, you should get paid for the risk you're taking. But that the way the market prices that risk is very different. And that is evidenced by default rates in the market. So in the last 30 plus years, 0.5%, 0.5% of companies that have been rated triple B or higher have defaulted, which is a minuscule number. And what that's telling us is that market is paying us to take on a risk premium, but that risk is not materializing. So that, in my mind, becomes a harvestable risk premium that we could embed into passive strategies. And that's the product we developed at VettaFi. We took advantage of this consistent bias. We took a measured risk-adjusted dip into triple B, so still staying within the investment grade segment, but we were able to create a portfolio that significantly outperforms the investment grade benchmark.
Implementing an approach like this, are there any risks that surface that investors might want to take account of? And how do they play out during, say, market volatility events? We're thinking 2022, we're thinking COVID drawdown sell-off that March, and also, of course, the 2008 GFC.
Yeah, no, 100% something that's front and center for us. So as we develop this index, this is not intended to be a panacea for the entire market, right? It is taking on active credit risk and we're getting paid for it. Now, when does a strategy like this not perform? It will underperform when there is periods of persistent stress that continue for an elongated period. So think something like the GFC. And even in GFC, the enhanced yield index did not underperform the benchmark significantly. It was like very minor. But something like that, that stays persistent, will cause an index that is overrated triple B to underperform significantly over a period of time. If you take something like COVID, where the markets shot down and then shot right back up, that is an amazing environment for this strategy. Because let's think about what happened. We overrated triple B. There was some kind of rebalancing that happened. A crisis happened in the market, and then it all shot back up. So in that segment, if you were overweight lower grade securities, you were handsomely rewarded. And, you know, we definitely try to look at drawdowns and stress periods, but for me, the full market cycle is much more important. So we backtested this algorithm to 2006 onwards. So covering most periods of major crisis in the last 20 plus years. And the strategy has consistently outperformed the benchmark, which tells us we're after something here. And that's the kind of products I want to start thinking about in fixed income that provide an innovative edge that allow you to be passive while taking advantage of a lot of the active components that are in play today.
It'll be very interesting to see. We hear a lot about active ETFs, new product development here in Europe. It'll be very interesting to see how this new strain of products plays out. The idea that enhanced doesn't necessarily mean active.
Right.
Yeah.
And that's a bit misnomer that we're correcting today.
Yeah.
When anyone hears enhanced, they all automatically think active.
Yeah.
And you know, we believe there are enough fundamentals from active to borrow into the passive side. And there are certain elements that we cannot borrow. You know, things like illiquidity premium. That is quite idiosyncratic in nature. And that's not harvestable in my mind.
Samarth, thank you very much, sir.
Thank you for having me.